without further ado, I think I can introduce our first keynote speaker. It's Ronnie Strifeler. I really appreciate your time and commitment to this event, and thanks for coming out. The monetary tipping point. We're going to talk about inflation and gold. And I'm really curious if this is just a head fake or if we actually have a breakout in gold, and you're going to enlighten us. I don't think you need any further introduction. Thank you so much, Ronnie. Danke dir vielmals.
Good morning, ladies and gentlemen. So I guess my job is to make you excited, to make you confident when it comes to gold, to commodities, to inflation. And having a look at my slides, I think I'll manage to make you more excited. Today I will make the case that we are at a monetary tipping point, a tipping point of inflation. I will discuss how we reach this tipping point, why inflation is not transitory, as Madame Lagarde over there at the ECB would like to tell us, and what investors can do to protect themselves in this new regime. But before, I want to thank Kai and the whole team. I know it's a real challenge. It's even more demanding to put together a conference, an international conference, these days during these circumstances. So big thank you to Kai and the whole team, and I look forward to a great conference. A couple of words about us. Well, we're based in Liechtenstein, one of the most secure, most stable countries in Europe, probably. We're asset managers. We're managing 5 funds, primarily in the commodity space. We run one inflation protection fund, but also in 2 funds, we combine the crypto world and the gold and the silver world, which was a pretty good decision in hindsight. We're very much driven by the Austrian School of Economics, and as you might know, we are the publishers of the annual In Gold We Trust report. This is this brick of a report that we publish every year. For 15 years now, we've got a couple of physical copies out there. We reached 2 million people this year. The Mandarin version, so if you want to practice your Chinese, the Mandarin version will be published on 15th of December, and it wouldn't be possible to give out such a big report totally free of charge without the support of our premium partners. So many thanks for that. Let me first turn to the theme of my talk, tipping points. Oxford language defines a tipping point as the point at which a series of small changes or incidents become significant enough to cause a larger, more important change. The sociologist Malcolm Gladwell helped to bring the term tipping points into popular usage in the year 2000 when he published a book of the same name, a book that I highly want to recommend. The tipping point is that magic moment when an idea, a trend, or a social behavior crosses a threshold, tips, and then spreads like a wildfire. Just as a single sick person or a bat can start an epidemic of the flu, so too can a small but precisely targeted push cause a new fashion trend. But tipping points are not confined to sociology. They can be observed in diverse areas ranging from physics to history and finance. The video behind us or in front of you gives us a simple but dramatic example of simple physics of a tipping point leading to precarious situation descending into chaos. You'll be pleased to know that the driver of the truck was unharmed, but his boss probably was quite unhappy. Ladies and gentlemen, what is crucial to understand, the tipping point demonstrated in this video was only made possible by the inherent instability in the warehouse layout. We can also see examples of tipping points in the realm of finance. Bank runs are a classic example. They result from a sudden loss of confidence, a sudden loss of trust, typically after risks have been built up over a much longer period of time. You'll all be familiar with the collapse of Lehman Brothers, or perhaps the collapse of the British high street bank Northern Rock in September 2007. Northern Rock was nationalized for 37 billion British pounds. Peanuts, I would say, in today's terms. Both banks traced their roots back to the 1850s, so they were around for more than 150 years until they collapsed. But just a few days, actually a few moments, were enough to send these banks into insolvency. And maybe the best tipping point example comes from 20th century history. The tipping point was an event that triggered momentous global changes larger than anyone involved could have imagined, the start of the First World War. The story is closely tied to my own country, Austria, and it was the assassination of Austrian Archduke Franz Ferdinand. It catalyzed a chain of events that went on to profoundly reshape Europe and the entire modern world. Ladies and gentlemen, what's important to understand is it was not the assassination alone that caused the war, but the precarious buildup of arms, rivalries, and tensions that came before and already developed for years, if not decades. The historian Christopher Clark wrote an excellent book about the build-up to the World War. He called it The Sleepwalkers, because he saw that Europe had long been sleepwalking into a catastrophe. It took the tipping point of Franz Ferdinand's assassination to reveal the extent of these tensions. So the assassination was the straw that broke the camel's back, a true tipping point. Now, I recount this lesson from history because I see it as relevant to the situation we find ourselves in today. I believe we have been sleepwalking into a new tipping point, a tipping point of inflation. This tipping point that I will describe now will trigger changes that will be primarily economic and monetary rather than, hopefully, military in nature. Now, what do I mean by this? Since the 1980s, a period referred to as the Great Moderation, Western economies have become accustomed to low inflation. Low inflation has persisted for so long that the idea of it rising on a long-term basis seems completely implausible to most economists, politicians, central bankers, and investors. I would say that a couple of months ago, saying that inflation will be structurally higher was probably one of the most contrarian positions that you can make. But I want to share with you today that I view the COVID-19 pandemic was the tipping point that will change this long-standing dynamic. COVID was a tipping point in a true sense because, like Franz Ferdinand's assassination, it was the straw that broke the camel's back. Longer-term policy decisions made current developments possible, and we're now moving from an era of primarily asset price inflation into an era of structurally higher price inflation. So what are these long-term trends that have built over the last couple of decades? The first I want to highlight is monetary supply growth. We can see from the graph that broad money, M2, the measure of money which is probably most relevant to inflation, has been accelerating since the year 2000. This trend was exacerbated following the global financial crisis, and one of the actions taken by central banks in response to the GFC was to flood commercial banks with liquidity in the form of base money to fend off a systemic collapse. M2 continued to grow solidly as a result, but it is only recently that its growth has started to accelerate again. And you can see that on this chart. In 2020, M2 money supply increased at the fastest rate on record, with the total supply of US dollars in circulation growing by 25%. As you can see on this chart, during the GFC, M2 grew by roughly 10% and then actually it collapsed. But now we're in a crisis where M2 actually is going significantly higher. So 25% last year, of course, due to the base effect, those numbers are coming down now, but we should not forget that those numbers are still much higher than in the inflationary, actually in the stagflationary 1970s. So given that M2 money supply has already grown so much, why haven't we seen much more dramatic inflation yet? First of all, because inflation is a process. Secondly, because there are always time lags involved. And thirdly, due to the lockdowns that we have experienced and probably will be experiencing again, a sharp fall in the velocity of money happened. If you look at this long-term chart starting at 1904, you can see that we're now at even lower levels than in 1933 and in 1946. In both cases, the US government resorted to radical measures to increase it again. In 1934, the US devalued the dollar against gold by almost 70%. In the period 1946 to 1951, it enforced financial repression in cooperation with the Federal Reserve, which kept interest rates at a low level. So basically they implemented a yield curve control, something that I see happening, definitely happening in the course of the next crisis. Currently, the velocity of money is at even lower levels than it was in 1933 and 1946. So therefore, we should not be surprised to see similarly extreme countermeasures of financial repression being implemented again. I'm pretty confident that at some point velocity will start rising, but my friend Russell Napier said, forecasting velocity is fiendishly difficult. It's like trying to juggle an incontinent squid, something you really don't want to do and you're very unlikely to succeed at. But it is absolutely true, and I'm absolutely certain that at some point velocity will start rising again and it will meet enormous amounts of liquidity that were created over the last couple of months. I now want to turn to a second but related long-term trend, the growth of global debt. We're all familiar with that, obviously. 24 trillion was added to the global debt mountain last year, pushing the total debt burden from 300% to 360% of GDP. The COVID crisis was a real tipping point when it comes to government intervention and fiscal stimulus. The best times of the so-called frugal Swabian housewife are a thing of the past. And perhaps you can tell that my last name, Strifeler, that's a Swabian name, and my dad is a Swabian, and he's very frugal. So he's very concerned about the policies that were implemented. In short, austerity is out. But the debt levels are now so great that the sensitivity to rising rates is higher than ever. It is now difficult to almost impossible for central banks to raise interest rates in the event that inflation picks up. Therefore, it's no coincidence that they keep telling us that inflation is only transitory. The world is caught in a zero interest rate trap, the title of a book that I published in 2019. So, ladies and gentlemen, growing out of the debt problem in real terms is simply impossible. A sustained turnaround in interest is less likely than ever. It's probably more likely that a Dutch skier, sorry Willem, will win the downhill race in Kitzbühel. One day. I mean, Marcel Hirscher, he's half Dutch, but he only went for the slalom, so no downhill. So, although we are being told that, you know, this is now the turnaround, we're seeing tapering and rates will rise in 2022, probably in summer, I would doubt it. I would have put a question mark to that. But we have seen now that the great moderation might be over, that money supply growth is accelerating, not just base money, but this time in this crisis, M2 as well. And this money supply growth is finally manifesting itself in higher inflation numbers, but we are being told that inflation is only transitory. These trends alone are enough to raise concerns about persistent inflation, but I now want to turn to some additional factors rooted in policy decisions and trends in the real economy that I see as further inflationary drivers. Fiscal regimes seem to increasingly resemble what our friends at Nordea called Opranomics. The main tenets include a policy that I would describe as going direct. So everyone gets a bailout, helicopter money and MMT-style policies, credit guarantees by the government, and universal basic income. These kind of radical ideas were previously only advocated by very left-wing voices. But since the COVID crisis, they have entered the mainstream. And ladies and gentlemen, as you know, politicians always calibrate their crisis responses based on the lessons learned during their most recent crisis. So direct transfers are now a permanent instrument, like QE, which was new after the GFC and is now a permanent instrument of monetary policy. And direct transfers will likely be used every time there is an economic setback. Going forward, CBDCs, central bank digital currencies, will be used to fine-tune the cycle and to avoid every recession via direct transfers. And this is an inflationary game changer, ladies and gentlemen. Compared to the decade of standalone quantitative easing being primarily an asset swap, fueling asset price inflation, now these measures of going direct have got a much stronger, much more direct influence on the economy and on inflation numbers. And the rise of Opranomics is part of a more fundamental shift that I see happening. This is a shift from monetary to fiscal dominance. One of the reasons for this is that the toolbox of stimulatory policies available to the Federal Reserve and central banks in general is largely exhausted. Sometimes it seems to me that Fed policy is the only thing that counts for markets anymore. Everybody tries to anticipate when the Federal Reserve will start tapering, if they will give us any hints. That's basically everything that financial markets care about, it seems. But what if central banks are becoming increasingly irrelevant? What if the days of monetary policy being the driving force are actually over? Andy Haldane, the outgoing chief economist of the Bank of England, wrote that for years after the Second World War, the Bank of England was effectively a think tank and that government did set interest rates. We could go back to that. Central bank independence might not be formally cancelled, but the power of central banks seems to be slipping away. And I now want to highlight another important trend that ties into this topic: the rise of government credit guarantees. Governments are going direct and are now circumventing central bank money creation. Earlier this year, I interviewed my dear friend, the financial historian Russell Napier, about his view on inflation and financial repression. Russell has been a deflationist for decades, but now he predicts sustained inflation. And he said the crucial structural change here is that the governments are providing credit guarantees to the commercial banking system. And now we have across the world bank credit growing really strongly in a recession, which is absolutely unheard of. He gave the example of the UK Chancellor introducing government guarantees on mortgages up to £600,000, announced in the March 2021 budget. And unlike QE or a reduction in interest rates, these schemes offer direct incentives for banks to increase lending, and they thereby expand the broad money supply. And since these government guarantees are loans, the risks associated with default are now being basically passed on to society at large. So ladies and gentlemen, be aware of this topic. It might sound a bit technical, but those government guarantees are a fundamental change in the way money is created. And as the power of central banks is slowly slipping away, we now see new tasks for monetary policy. Safeguarding price stability has always been considered a central objective of an independent central bank. In fact, it is the central mandate of the ECB. But increasingly, one gets the impression that central bankers are speaking out more often on issues such as sustainability, climate change, or diversity than on monetary policy matters. They actually often sound like Greenpeace activists or social workers. It's totally fine if they've got a private opinion on these topics, but from my point of view, they're missing their central mandate. Christine Lagarde, for example, against all custom, made a public statement of support for the Green Party's top candidate in the German general election. Another important policy change is the move to average inflation targeting. In August 2020, Chairman Jerome Powell indicated that the Federal Reserve would start adopting this policy. What this means in practice is that since inflation numbers have been lower than targeted, the Fed will allow inflation to overshoot its target in the years to come. So inflation numbers were too low in the last couple of years. Now we've got leeway for inflation numbers to overshoot. We've also seen similar indications from the ECB. This means that in the event that inflation sustainably picks up, major central banks will be less likely to tighten policy to keep it under control. And as you can see on this chart, it actually works. Since Jay Powell introduced average inflation targeting at the Jackson Hole meeting, actually inflation expectations are on the rise again. I now come to some further inflationary trends in the real economy. Supply chains are distressed due to high restriction levels and a zero COVID policy, particularly in Asia, but also in Australia and now in many more countries. We have seen partial close downs of the ports in Ningbo, Suzhou, which is the third busiest port worldwide, in Yantian and in Dalian due to COVID-19 outbreaks over the last couple of weeks. This has led to a bizarre and remarkable surge in the price of shipping rates. And as far as we can judge, there is no political momentum whatsoever towards scrapping the zero tolerance policy in China. This likely means that supply chains will remain distressed for the next couple of months and perhaps even years ahead. One of our clients, he owns a shipping company, and he said, well, actually, it's going to last for at least 18 months until we go back to normal. And if I would own a shipping company, I mean, I would be super happy about those prices. Of course, it will come down, the market will solve it at some point, but at the moment, it seems that this will stay around for longer. So perhaps we should all order our Christmas gifts a bit earlier than usually. On top of the policy changes, geopolitical and demographic shifts are also taking place. Geopolitically, we're seeing tensions rise between the US and its allies on the one hand and China and Russia on the other. These tensions could reduce the volume of international trade, resulting in less international division of labor, lower economic efficiency, and rising consumer prices. What you can see on this picture is the last US-China summit that took place in Alaska. We shouldn't underestimate the symbolic character. And we have all read that the atmosphere was extremely chilly, almost hostile. So the fact that China used to be exporting deflation for the last couple of years, perhaps decades, moving to an exporter of inflation is, from my point of view, a very important fundamental driver for inflation. Now, I've given you a brief overview about the topics that I see as relevant when it comes to the topic of inflation, a topic that we really focus at Incrementum. Now let's talk a bit about gold. Those who know it best love it least because they have been hurt the worst. And actually, until I would say 2 weeks ago, it was pretty tough to stand up and make a positive case for gold. This has changed now, thank God. But as you know, ladies and gentlemen, trust comes from repeatedly fulfilling expectations. And we shouldn't become too greedy. Gold did its job perfectly in 2020. Like a solid defender in your team. What's the best German defender? Franz Beckenbauer, Mats Hummels? What's your view? I don't know. But it did its job as a solid defender very well. It hedged against the market turmoil in equity markets. It hedged against rising inflation and against the recession last year. So gold was up 25% last year, which might be a coincidence, but I told you before that M2 grew by 25% last year. But still, people are a bit upset and frustrated with the performance, and so am I. We should not get too greedy. I think, ladies and gentlemen, the job of gold is not to make you rich quickly. The job of gold is to preserve your purchasing power. If you want to get rich, buy mining stocks, perhaps some of them that are here, or Bitcoin. But as you can see on this chart, actually since the beginning of the year, and we saw in US dollar terms 2019 gold being up 18%, last year 25%. Year to date gold is only down 2.4%, which is not too bad. Actually in euro terms, merci beaucoup Madame Lagarde, gold is up 3%. In Japanese yen terms, it is up 7.7%. So despite the fact that everybody still is extremely, I would say, negative and the market couldn't care less about gold, I think the performance of gold is actually quite okay. And as you can see on this chart, actually the average annual gold price is making a new all-time high in 2021, which should be a pretty good environment for gold producers. Now this, ladies and gentlemen, is from my point of view, and we wrote roughly 3,000 pages of research about gold. I think if there's just one number that counts that I would have to pick, it is real interest rates. And as you can see on this chart, in the 1970s, we had primarily negative real rates. Then the 1980s and 1990s, horrible 2 decades for gold investors. We had primarily positive real rates. And since the beginning of 2003, we see primarily negative real rates again. And given the facts, given those debt piles that we have accumulated over the last couple of years, do you think that real interest rates will rise significantly? Do you think that we will see real rates at +3, +4%? If yes, then you should sell your gold. I just don't see it. It's not possible anymore. And I see some interesting developments also behind the curtains. Things that show me that the gold market has also experienced a tipping point. Central banks globally are gradually increasing their gold reserves. This is particularly true in economies like Russia, which are seeking ways to limit their exposure to the US dollar and US dollar denominated assets. Actually, Russia has more than quadrupled its gold reserves since the year 2000. We have seen similar moves in countries such as Thailand, Brazil, Hungary, and Poland, which have historically also experienced high numbers of inflation. And we're also seeing increased interest in gold when it comes to institutions. The major data analytics software maker Palantir disclosed the purchase of $50 million of physical gold bars. Palantir is mentioned in The Lord of the Rings, and it is the indestructible ball of crystal used for communication and to see events past or future. If you know Palantir, then you will know that it is probably one of the best connected companies out there. Their clients are mostly government agencies and the defense industry and intelligence agencies. And their CEO, Shyam Sankar, cited the possibility of hedging against black swan events as the reason for the purchase of physical gold. Quite interesting. Now, what's missing? I think what's really missing is the participation of institutional investors. Talking to institutional players, I can tell you they couldn't care less about gold at the moment. And I think the number that is most relevant when it comes to the participation of institutional players is ETF demand. ETF holdings are following the price of gold. So every time the price of gold rises, there's inflows into the ETF space. Every time the price of gold falls, we're seeing outflows. At the moment, it is kind of stabilizing, but we haven't seen really big inflows from institutional players yet. Now let's talk briefly about mining. Well, I attend quite a lot of conferences, and some of you already know this one. I went to Colorado for the Precious Metals Conference, Precious Metals Summit, and also Denver Gold Show. And I had to apply for national interest exemption. So I basically had to tell the US government why it is in the national interests of the United States of America that Ronnie comes over to the US and why it will influence US GDP. Somebody said that President Biden signed it personally. I made it to the US, and two fantastic conferences, and of course we shouldn't overestimate it because of all those COVID measures being taken, but I thought it was pretty interesting.
Just before 8 a.m.
Quick, somebody stopped that gold investor from leaving. So this was the huge venue at the Colorado Springs conference, the Denver Gold Show, and usually, back in the good old days, this was packed. And actually, I think we saw the all-time high of attendance at a speech when Mark Bristow gave his keynote, and it was roughly 22 people, I would say. So this is a sign that I think we are, quite far away from euphoria in this market. Now have a look at those numbers. I think if you compare the GDM index, which is the Arca Gold Mines index, if you compare some numbers, profitability, price book, price sales, margins, gross margin, operating margin, profit margin, return on capital, free cash flow yield, dividend yield, debt levels compared to the S&P 500, I'm seeing quite a lot of value in this space. And actually what I like is a divergence between value that I see and investor sentiment that is, as you saw before, quite negative. I would say that the mining space is, in German we would say spottbillig, or I could make the joke sprottbillig. So it's no coincidence that Eric Sprott has invested so much of his capital into the mining space because he sees value. And actually gold mining is more profitable than ever. This is the free cash flow of the top 50 miners by market cap, and it will make a new all-time high this year. 3 charts that I got from my dear friend Tavi Costa at CrashChat. As you can see, miners have been reluctant to spend capital even though gold prices have been moving higher. Thus, supply is constrained, which is an incredibly bullish fundamental backdrop for gold and silver. And because of a decade of exploration underinvestment, there have basically been no major gold discoveries in the last couple of years, which will lead to a pickup in the M&A cycle. We already saw Agnico Eagle and Kirkland Lake with their merger. I think it's a good deal for Agnico, not so for Kirkland. We saw the takeover of Pretium by Newcrest. We saw Corvus Gold being taken over by Anglo. But I expect, and this what you can see on this chart, as soon as gold prices start rising again, I see a significant pickup in M&A activity. And this is just a chart to show you how far we are in this cycle. This shows you bull markets in the BGMI since the year 1940 actually. So normally at the end of every trend you see this mania phase, this parabolic phase. This is probably the most boring bull market that one can imagine. So we are still far away from this mania phase. Now, where's this all going to lead to? If you say, well, inflation might perhaps not be transitory, what works in inflation? We crunched the numbers, and actually commodities and gold have got the highest inflation beta. Commodities are doing extremely well this year. As you know, gold kind of anticipated that already last year. So if you say, well, inflation will be sticky, then definitely those 2 asset classes should do pretty well. And you know I like long-term charts, so this one is since the year 1815. I think, Claude, you were not around at this time. So they would indicate that we're due for a price surge. The graph behind me demonstrates where we are today, showing that measured with the 10-year CAGR, compound annual growth rate, commodities are heavily undervalued. We all know commodities have been in a brutal bear market for more than 10 years, which resulted in a significant lack of activity, investment activity, and declining production volumes. The increasing focus on fiscal stimulus, ladies and gentlemen, infrastructure projects and so on, will stimulate the commodity sector much more than it was the case in the pure QE paradigm. And as I can tell you, institutional players are not invested at all in the commodity space. So this is a super cycle that nobody is invested in yet. When I talk to institutional players, they say, well, it's already too high. We don't like copper at this stage. Nickel is already too expensive. Oil is already too expensive. So from my point of view, at some point, big money institutional inflows will start coming in, but so far this hasn't happened. I don't know if there are still silver bucks around. Hopefully. So this is should give you some confidence. Well, actually silver relative to gold is very, very cheap. Again, a long-term comparison since the year 1800, the gold-silver ratio, we're significantly above the median value at 30. So if you believe that gold will make new highs over the next couple of months and years, then you should at least own some silver. And this one is for the technicians here. Well, actually, this could be a textbook cup and handle formation. So once we break out above this resistance zone, and at the moment it looks pretty good, once we reach new all-time highs, it can go pretty quickly. And we should not forget that those players that are very important these days, managed futures, systemic traders, they're not invested yet, but their systems, they see that there is something happening. And as soon as their signals go on green, I expect much, much more momentum kicking in. So having a look at this chart, gold is still very, very cheap. Not only in absolute terms, but also in relative terms. If you compare the price of gold to the previous highs, 1980 and 2011, you can see that compared to the monetary base, to the M3 money supply, to US federal debt, to GDP per capita and so on, and especially to the S&P 500, gold is very, very inexpensive. And our proprietary model, which we published and announced last year in the In Gold We Trust report, it indicates a price target of $4,800 in 2030. Well, I worked in a bank for a couple of years, and I know that the more sophisticated the models are, the less they work. So actually our gold price model is pretty simple, and you can read everything about the model in our 2020 In Gold We Trust report. Now $4,800 sounds like quite a lot, but actually this is a compound annual growth rate of 11%. Is it impossible? From my point of view, definitely not. And that leads me already to the conclusion. It's a good sign that nobody fell asleep yet. Nobody is staring at their cell phones. That's always a very good sign. From my point of view, ladies and gentlemen, higher inflation rates are not transitory. We have seen that in recent decades, investors, politicians, and central banks have become accustomed to low to moderate inflation. But we have now reached a tipping point where inflationary forces are stronger than deflationary forces. There are obviously still deflationary forces. I just finished reading the book by Jeff Booth, The Price of Tomorrow, a fantastic book, where he makes the case for deflation coming from technology. Yes, absolutely. The normal state of our monetary system, of our market economy, would be highly deflationary. But within our monetary system, deflation cannot be accepted systemically. And now, as I've laid out, the inflationary forces in this pendulum are getting stronger than the deflationary forces. Central banks will continue to intervene in markets, but power will increasingly sit in the hands of fiscal authorities. So you should listen perhaps less to what central bankers say and more to what politicians say, and especially what politicians do. Debts are now so large that interest rates will not be allowed to rise. The result will be an era of negative real interest rates. We continue to see a tremendous amount of value in the mining sector. We predict that 2021 will be the most profitable year for the sector. And we expect gold to fulfill its historical role as an inflation hedge, a systemic insurance, and a trustworthy store of value. New all-time highs are possible in the next couple of months, and we see $4,800 as the most likely gold price in 2030. Ladies and gentlemen, like European powers in the build-up to World War I, I believe we are sleepwalking into a new tipping point from disinflation to inflation. Gold miners, and commodities provide the cleanest, most under-owned, and cheapest insurance policy for the changes that I see coming. Now, thank you very much for your attention. I hope you enjoyed it. I did so very much. Thank you very much. There's still some time for questions. 2 minutes. Claude. So, I hope you're not mad at me for this joke.
Fantastic presentation. So it's a good start for this conference. So we're at the beginning phase of an inflationary cycle. What does that mean for the general stock market, in your view? Because some people talk about a melt up, some people talk about crashes, some people say, well, it's going to be sort of level for years. But it's a question that's important because a lot of gold bugs are afraid. A lot of gold bugs are afraid that if the general market goes down, then it could have negative inflation for the miners, which is historically not the case. But what's your view?
Well, I mean, the likelihood that another crash is going to happen is definitely is there, and I don't know when it's going to happen and where the black swan will be coming from. I think it will not come from the financial markets. It will probably not come from the health side. It will be something different. Perhaps it will be a geopolitical event. But from my point of view, during the COVID crisis, we have seen that all taboos are being broken. So I think for the next crisis, at some point the Federal Reserve will start buying equities. They will implement yield curve control, which is basically quantitative easing without any limits. So this is going to happen. So is our equities an inflation hedge? Yes and no. We crunched the numbers. We actually put out the inflation special report last year that we called the boy who cried wolf. And we said that actually it really depends on the sector that you are in. There are many sectors that have got pricing power, but if those companies do not have the pricing power, they actually suffer in an environment of inflation. I think what we're seeing now on the mining side is we're seeing, if you look at Q3 numbers, I think that we saw that on the cost side, there's definitely developments happening. We're seeing that, I wouldn't say that margins are being squeezed, but definitely labor, but also energy prices are a problem on the mining side. But still, I mean, margins are ridiculously high, especially from a relative point of view. So if you say inflation will stick around, I think the mining space and other sectors like the tech space, for example, pharmaceuticals, which have pricing power, they should do pretty well. But I will be around for the whole conference. There are a couple of printed copies of our reports out there. So thank you very much for your attention. Thanks.